Do you remember when everyone said silver was just another commodity? When the talking heads on financial television insisted precious metals were relics of the past? When your broker dismissed your interest in physical assets as paranoia? Well, nobody's dismissing it today. It's Monday, January 19th, 2026, and if you've been watching the retail bullion market over the past 3 days, you've seen something unprecedented in modern precious metals history. And no, we're not talking about price swings. We're talking about the collapse of infrastructure. The largest precious metals dealer in the United States just sent an emergency message to its customers. APMEX, a company that handles hundreds of millions of dollars in transactions every month, has now instituted a $500 minimum for all online orders. Let that sink in. $500. That means you can't order a single tube of Eagles, you can't get 10 ounces of generic rounds, you can make a purchase, unless you cross a threshold that would have seemed absurd just 6 months ago. And here's the kicker, this is just the beginning. 4 days before that, the same company imposed a $10,000 minimum on buybacks. If you want to sell silver back to them, you have to send at least $10,000 worth before they'll even look at it. What we were witnessing is the retail distribution system straining under pressure it was never built to handle. The pipes are bursting. The infrastructure connecting miners, refiners, wholesalers, dealers, and finally your doorstep is breaking down in real time. And the most startling part? This is happening while silver trades at $93 per ounce. Not $100, not $150, $93. Imagine what happens if we hit triple digits. If the system is collapsing at $93, what does it look like at $200? Most people see a headline like APMEX introduces $500 minimum and shrug it off as a policy adjustment, a business decision designed to improve efficiency. It's not. This is a distress signal. APMEX is drowning in order volume and cannot process the flood. Let's look at the numbers straight from their CEO. Last week, from an order count perspective, was the fourth highest week in APMEX history, fourth highest ever, and that number was 40% higher than the week before. Under normal conditions, the average order count for APMEX is roughly half what they experienced last week. They're operating at 200% capacity. Every part of their system, staffing, inventory management, shipping logistics, was built for a different world, a world where silver traded between $20 and $30, a world of stable, predictable demand. That world is gone, and it gets worse. On the buyback side, even with the $10,000 minimum cutting out roughly 20% of incoming buyback orders, volume remains in the top 5 in company history. Translation: even after telling small sellers to step aside, the flood of people trying to sell metal back to them is overwhelming. Why? Because the prices move so fast that retail holders are panicking. They're taking profits, they're liquidating, and the dealers cannot handle the flow. Picture 2 tsunamis colliding. Record buying on one side, record selling on the other, and in the middle, a distribution system it was never designed to manage. The $500 minimum isn't about profit, it's about survival. Every small order takes the same amount of administrative labor as a large order. Someone has to process the payment, pull inventory, package it, generate tracking. When you're running twice your normal order volume, every low-dollar transaction becomes a bottleneck. The $500 minimum is triage. It's a battlefield decision, and it tells you everything about the state of the retail market. And there's another key piece most people miss. APMEX runs its own private mint, producing roughly 90% of the silver bars and rounds sold under its house brand. This gives them a massive advantage over competitors who rely entirely on third-party suppliers. They can respond faster to demand than anyone else in the industry. Yet, even with that advantage, their output has been cut by 50%, half capacity. Why? They can't source enough blank planchets. Refineries are at full tilt, running 24/7, turning away new orders, prioritizing industrial contracts. Retail dealers are getting squeezed. Now APMEX is warning that pre-sale delivery dates for silver are now 3 to 5 days longer than the previous week. And the previous week's delays were already stretching patience. This is not a temporary backlog, it's a structural breakdown. And this is just one dealer. Imagine what's happening to smaller regional dealers, coin shops, and online retailers that rely on wholesaler inventory. Many are halting orders, hiding pricing, or selling only to existing customers. The retail infrastructure is disintegrating, and the price is still climbing. So why is this happening? Why is the retail system breaking at $93 when it functioned at $30? The answer isn't just price, it's velocity. It's the speed of the move and the psychology it creates. Silver started this year around $71 per ounce. 19 days in, it's up 31%. Annualized, that's a mind-bending number, breaking every historical model. This isn't just a bull market. This is a melt-up, a market remonetizing in real time. And when an asset moves this fast, it attracts 2 types of buyers. First, industrial users. solar panel companies, electric vehicle manufacturers, data center operators. They need physical silver to keep production running. They don't care about price, they care about supply. They bypass retail entirely, going straight to refiners, signing offtake agreements, locking in metal before it ever reaches the open market. This explains why coin shop inventories are draining even as prices climb. The metal is being pulled into industrial stockpiles. Second, speculators. These are the people seeing 31% gains in 19 days and thinking the party is just getting started. They're not buying because of monetary history. They're buying because the chart is vertical. They leverage up, max out credit cards, liquidate other investments, pour money into ETFs, futures contracts, and demand physical delivery, and the system isn't built for it. In normal markets, roughly 95% of silver transactions are paper-based, ETF shares, futures contracts, unallocated pool accounts. Physical silver moves slowly relative to the velocity of paper trading. But today, the velocity of demand for physical metal has broken the system. Retail dealers are struggling to keep up. Their staffing and logistics overwhelmed. Their minting capacities stretched to the limit. Even when a dealer like APMEX can produce its own metal, the upstream bottlenecks, refiners, blank planchets, industrial demand limit output. It's a perfect storm. And what happens next is almost inevitable. Pre-sale delays lengthen further, minimum order thresholds rise, and smaller players are squeezed out entirely. The retail market for silver is undergoing a structural transformation in real time. Here, a bottom of the broader picture, the retail system was never designed for this kind of bidirectional pressure. The combination of record retail buying, industrial hoarding, and speculative panic is exposing a fragility that few outside the industry understand. You're witnessing a market infrastructure crack under stress, not because of manipulation, not because of a policy error, but because of sheer, unprecedented demand and velocity. The implications are enormous. Anyone hoping to casually acquire physical silver at normal price levels may find themselves shut out entirely. Coin shops are already rationing, online retailers are raising minimums, and private mints are constrained by upstream supply. Even if you have the cash, access is increasingly limited. And the irony? This is happening while prices are still reasonable by historical standards. Now, if the price doubles, as some analysts predict, we're not just talking about higher numbers on a screen. We're talking about systemic pressure that could overwhelm the entire retail infrastructure. Every dealer, mint, and coin shop could experience the same stress as APMEX. Supply will be rationed, delays extended, and small buyers effectively locked out. For investors and collectors, there's an important takeaway. The market is signaling scarcity, not just in price, but in availability. Physical silver is moving faster than it can be supplied, and the longer this continues, the harder it becomes to acquire through normal channels. The game has changed, and those paying attention now have a crucial window to act before the distribution system is further strained. This isn't fear-mongering, it's market mechanics in action. Infrastructure fails when overwhelmed, and right now the system connecting miners, refiners, wholesalers, and retail customers is under unprecedented stress. The $500 minimum is not arbitrary. It's a triage measure to focus resources on larger transactions that make the system functional. The $10,000 buyback minimum is not profit-driven. It's to prevent operational collapse. And the feedback loop is intensifying. High velocity leads to panic selling, which increases administrative burden, which leads to minimum order thresholds, which then drives further speculation and industrial hoarding. It's a self-reinforcing cycle that's hard to stop once momentum builds. We are witnessing a modern anomaly, a physical market moving faster than the infrastructure built to support it. Retail participants are learning the hard way that in times of rapid price appreciation, access is as critical as capital. Those who waited for convenience or ignored warnings may find themselves sidelined. So remember this moment. Take note of the numbers, the minimums, the delays. What looks like a small policy tweak is actually a flashing warning light for anyone tracking precious metals. The retail market is breaking, not gradually, but structurally. And as prices continue to climb, expect this pressure to magnify. Supply chains will tighten, smaller players will be squeezed out, and availability will become the ultimate limiting factor. We are at a tipping point. The combination of industrial necessity, speculative fervor, and fragile infrastructure has created a perfect storm. The market is no longer just about price. It's about access, speed, and the ability to navigate a system under extreme stress. And the clock is ticking. Most people never notice how fragile a system is until it's stressed. When everything works, it feels permanent, reliable, boring even. But stress reveals truth, and right now the silver market is under stress in a way most investors have never seen before. Under normal conditions, only about 5% of buyers ever take physical delivery of silver. The rest are perfectly happy with paper exposure, ETFs, futures, pooled accounts, ledger entries that promise metal somewhere, someday. That works fine when prices drift slowly and confidence is high. But when silver goes parabolic, that ratio flips. Suddenly it's not 5% anymore, it's 20, sometimes 30. And those buyers don't want promises. They don't want clauses buried in prospectuses explaining how delivery may be cash settled at the issuer's discretion. They want weight, they want bars, they want metal they can hold. That shift alone is enough to break the retail system. Dealers aren't built for that kind of delivery demand. They respond the only way they can, by raising premiums, extending delivery timelines, and imposing minimum order sizes. Not because they're greedy, but because they're trying to slow the flow before the system overheats completely. The problem is, it's not working. Because at the same time, the other side of the market wakes up. The long-term holders, the stackers who bought silver at $25, $30, maybe even lower. They're sitting on 300% gains, and some of them decide it's time to take a little off the table. Not all of it, just enough to rebalance. That means dealers aren't just overwhelmed with buyers, they're flooded with sellers too. In a normal market, that's a dream scenario. Dealers buy metal from the public and sell it to new buyers, capturing the spread. Inventory recycles smoothly. But this isn't normal. The volume is extreme. They don't have enough staff to process buybacks, not enough vault space to store incoming metal, and not enough cash on hand to settle every request immediately. So they impose buyback minimums, $10,000 or more. Small sellers are politely told to go elsewhere, except there is nowhere else to go. Local coin shops are overwhelmed. Pawn shops don't have the liquidity. Online competitors have identical restrictions, so buyers are stuck, sellers are stuck, and dealers are wedged in the middle trying to manage chaos with systems designed for calm, predictable markets. This is what infrastructure failure actually looks like. No explosions, no headlines screaming collapse, just bottlenecks everywhere, all at once. And remember, we're still at $93 silver. The real stress hasn't even arrived yet. To understand where this is going, you have to zoom out beyond retail. What's happening at APMEX and other dealers is a symptom, not the disease. The real signal is coming from a place most people aren't at T watching closely, the United States Mint. Last week, the Mint executed the most aggressive repricing event in its modern history. 1 week ago, proof silver eagles were priced around $95 per ounce. Today, that number is $173. That's an 82% increase in 7 days. Uncirculated silver eagles jumped from 91 to 169. Presidential silver medals went from roughly 90 to 164 overnight. These aren't bullion products. These are numismatic items that already carry hefty premiums under normal conditions. An 80+% price hike in a week is not adjusting to market conditions. It's panic pricing. Officially, the Mint will tell you this was about updating pricing models. Internally, the story is simpler. They were being arbitraged into the ground. Buyers were acquiring silver from the Mint at 90 per ounce and immediately flipping it on the secondary market for 120 or 130. The Mint was effectively subsidizing speculators, selling silver below replacement cost. That's not sustainable. What matters most is speed. Just 2 weeks earlier, Mint representatives said pricing changes take about 30 days to implement. That's the standard process. This time, it took 7. That tells you how severe the pressure was. They pulled products offline, recalculated, and came back with prices that don't on T reflect where silver is, but where they believe it is going. Think about that for a moment. 173 per ounce isn't a random number. It's a defensive price. It's what the U.S. government believes it needs to charge today to avoid losing money tomorrow. That means they're pricing in $100, $120, maybe $150 silver as a baseline assumption. And here's the part that should really get your attention. Even at 173, those products are sold out. Not because demand vanished, but because supply did. The Mint doesn't have the blanks. They don't have the raw planchets needed to strike new coins. They rely on the same refining network that retail dealers rely on, and that network is already maxed out. The Mint is competing for refined silver and losing. As a result, numismatic silver sales are halted. Orders are suspended. The only remaining products, Bullion Silver Eagles, are subject to strict weekly allocations. We are watching the sovereign mint of the largest economy on Earth acknowledge that it cannot source enough silver. That matters, psychologically and structurally. When the entity that's supposed to be the ultimate backstop starts rationing supply, the message is clear. Scarcity is real, and scarcity feeds demand. Demand pushes prices higher. Higher prices encourage more hoarding by governments, by industrial users, by anyone who can secure long-term supply. And retail gets squeezed even harder. This is a feedback loop, and we're still early in it. Now consider what happens if silver hits $120 or $150. Does the Mint shut down silver production entirely? Do silver eagles disappear? If that happens, retail demand doesn't evaporate, it redirects. Straight into private dealers. Straight into an already overloaded system. That's how a manageable fire becomes an inferno. And the most powerful force behind this entire cycle isn't retail investors. It's not even central banks. It's industry. Picture a meeting inside a major tech company, Apple, Microsoft, Google, Amazon. They're planning a multi-billion-dollar data center designed to support artificial intelligence workloads. Hundreds of thousands of servers, massive computing density, and every single component inside that facility relies on silver. Circuit boards, semiconductor packages, switches, connectors. Silver isn't optional. It's the best electrical conductor available. Without it, the entire system underperforms. Someone inevitably asks, how much will the silver cost? The procurement team runs the numbers. At current prices, silver represents maybe 0.05% of the total project budget. A rounding error. Invisible. So the answer is immediate. Lock in the supply. Price is irrelevant. Delays are unacceptable. This is the dynamic breaking the silver market. When a material is mission critical and represents a tiny fraction of total cost, price stops mattering. These buyers will pay $50, $100, $200 per ounce if that's what it takes. And there is a new category of demand that didn't even exist at this scale 5 years ago. Artificial intelligence. AI data centers are among the most silver-intensive infrastructure projects ever built. A single hyperscale facility can consume millions of ounces, and the tech giants aren't building one or two, they're building hundreds. Microsoft is allocating roughly $80 billion this year to AI infrastructure. Google is spending around $75 billion. Amazon is committing over $60 billion. These aren't projections, they're funded plans. And every dollar of that spending pulls silver out of the market. Wall Street hasn't caught up yet. Most demand models still focus on jewelry, solar panels, and traditional electronics. They haven't priced in the reality that the cloud runs on silver, but the tech companies know, and they're not buying from coin shops. They're not calling retail dealers. They're going straight to refiners, locking in long-term offtake agreements, securing supply before it ever reaches the open market. That's why inventories are collapsing even as prices rise. The metal is being diverted upstream. So when you see higher premiums, longer delays, order minimums, and rationing, understand what you're actually witnessing. This isn't mismanagement, it's structural stress, a system built for stability encountering a world defined by speed, scarcity, and competition for physical assets. And if this is what $93 silver looks like, the question isn't whether things get tighter from here, it's how fast. What most people still don't grasp is that this silver isn't just being bought, it is being removed. Quietly, methodically, and in many cases, permanently. It's flowing into strategic stockpiles, long-term contracts, and industrial pipelines that never feed back into the retail market. Once that metal goes in, it doesn't come back out. When silver is embedded into a data center, it's not like a gold coin that can be melted down later. That metal is locked into circuit boards, connectors, and infrastructure, designed to operate for 10, sometimes 20 years. It's not recycled. It's not recovered. It disappears from circulation. Every ounce committed to AI infrastructure is effectively gone for a generation. That's not just demand, that's permanent supply reduction. What we're watching right now is the physical market splitting in two. On one side, industrial users are securing silver directly through private contracts, bypassing public markets entirely. On the other side, retail buyers are fighting over what's left, and what's left is shrinking by the day. APMEX raises minimums because it can't source enough metal for small orders. The U.S. Mint reprices aggressively because it can't get blanks. Coin shops have lines out the door because buyers can't find inventory online. This isn't coincidence. It's cause and effect. The infrastructure isn't failing because demand is too high in abstract terms. It's failing because the metal itself is vanishing into places that Donna T give it back. And the market hasn't fully priced that reality in yet. When it does, $93 will feel like a gift that people hesitated to unwrap. But before anyone gets carried away with visions of endless upside, let's slow this down and inject some realism. Because strong fundamentals don't create smooth markets. They create violent ones. Scarcity doesn't mean steady climbs. It means sharp moves, sudden reversals, and painful lessons for anyone who mistakes momentum for safety. We've already seen this movie play out multiple times in the last few weeks. On December 29th, silver pushed through $80 and sentiment hit a fever pitch. Every chart looked perfect. Every commentator declared $100 inevitable. And then, in a single session, the market dropped 16%, from $83 straight down to $70. Billions in leveraged retail capital disappeared. Anyone who chased the breakout with margin didn't get a second chance. Their positions were liquidated before lunch. Then, January 8th arrived. Silver recovered to $82. Confidence returned. Optimism surged. And the same thing happened again. Another sharp sell-off, another rug pulled out from under late buyers, this time a 12% drop in hours, straight down to $74. Fast forward to January 15th. New highs again. $93. Euphoria everywhere. By lunchtime, we were trading at $86, 7% gone in a blink. If you're sensing a pattern, good, you're paying attention. Every new high has been followed by a rapid engineered counterattack. December 29th, down 16%. January 8th, down 12%. January 15th, down 7%. This isn't randomness. This is algorithmic behavior. The banks see the order book. They know exactly where stop losses are clustered. They know how much leverage is in the system. And if they push the price just far enough, those stops turn into forced selling, which turns into cascading liquidation. It's financial judo. They use your leverage against you. And here's where the danger is highest, right at the top. At $93, silver is at the highest level in modern history. That doesn't make it safer, but it makes it more fragile in the short term. The more people pile into leveraged longs, the easier it becomes to tip the boat. This isn't fear-mongering, it's physics. If you buy a futures contract at $93 and the market drops 10%, silver trades at $83.70. On 10-to-1 leverage, that move wipes out 100% of your capital. Game over. You're not wrong on fundamentals, you're just gone. And the cruel irony? The next day, the price may rebound to $100 as industrial demand reasserts itself. But you're not there to see it. You were washed out at the bottom. That's the vertical trap. The banks can't stop the long-term trend. They can't print silver for Microsoft or Google. They can't manufacture physical supply, but they can still dominate the short-term battlefield. They can still punish impatience and overconfidence. This is why physical ownership matters. The investor who bought physical silver at $83 didn't get margin called when the price dipped to $70. His silver didn't vanish. He didn't panic. He waited. And today, he's comfortably ahead. Physical silver doesn't have leverage. It doesn't have stop losses. It can't be hunted by algorithms. When you hold the metal, a $10 drop on the COMEX is just noise. We are entering a period of extreme volatility. Swings of $10 or $15 in a single session are no longer outliers. They're expectations. So ask yourself an honest question. If you woke up tomorrow and silver was down $8, would you panic? If the answer is yes, you're overextended. The trend is up. The destination is likely triple digits. But the road from $93 to $100 is littered with traps designed to shake out weak hands. Now comes the part nobody likes to talk about, the exit strategy. Because when you're sitting on a 300% gain and the price keeps climbing, the temptation to sell becomes loud. You start doing mental math. You multiply your ounce count by the current price. You imagine what that money could buy. This is where most people lose. They trade a scarce asset for an infinite one. They swap the lifeboat for a ticket back onto the Titanic. Let's be clear. The dollar is not the destination. The dollar is the casualty. Silver isn't getting expensive. The currency is getting weaker. When silver moves from $70 to $93 in 19 days, that's not appreciation. That's devaluation showing its face. You're not getting richer. You're preserving purchasing power while everything else erodes. So rule number one is simple. Don't sell for dollars unless you have an immediate, unavoidable need for cash. Selling silver and parking the proceeds in a bank account accomplishes nothing. You've just exchanged metal for paper, and the paper is depreciating faster than the metal is appreciating. Rule number two is what old school hard asset investors understand instinctively. Ounces to acres. You sell when you can convert silver into a cash flowing hard asset. Historically, at the peak of silver's last cycle in 1980, it took roughly 800 ounces to buy the average U.S. home. Today, even at $93, it still takes around 4,500 ounces. That ratio hasn't compressed yet. We're not there. You wait for the moment when you can trade a monster box for a deed, when you can walk out of a closing with income-producing property instead of paper promises. That's not trading, that's transmutation. Rule number three may be the most important of all. Prepare for cash settlement. If your exposure is through futures, ETFs, or unallocated accounts, read the fine print. Every one of those instruments includes a clause allowing cash settlement if physical delivery becomes impractical. And when silver hits $150 and there's no metal available, that clause will be exercised. You'll receive a check. You'll feel paid. Then you'll take that money to a dealer and discover the street price is $300, or that there is no inventory at any price. You were paid in a currency that can no longer access the asset. That's not a win. Physical ownership has no counterparty risk. No one can default on a coin in your hand. We're sitting at $93. The psychological pull of $100 is strong. The fundamentals are undeniable. Industrial users are desperate. Retail infrastructure is cracking. The mint is rationing. Everything points higher. But the banks are watching. They're patient. They may engineer one more flush to $85 or $80 just to shake out late arrivals. If that happens, don't panic. Look at your stack. It's still there. Same weight, same shine. A paper crash is a gift. one last chance to exchange weakening currency for enduring metal before access, not price, becomes the real barrier. The train is moving. Stay seated. And don't let anyone scare you into handing over your metal right before the destination comes into view.